The founders who bootstrap, they all have confidence in their convictions because they had to figure it out. And so in no instance has it been easy for them. And they've thought, I might not make payroll, or how am I going to get through the financial crisis? But they've had to figure it out because they haven't had other resources around typically to help them.
Welcome, everybody, to another week of Wealth Wisdom, where we're helping you build wealth and legacy.
Companies are like an organism trying to survive.
It's always a risk when you're investing in a company that's purely tied to someone's brand.
45% of Americans have gone into debt for a Disney trip. All right, welcome back to another episode of Wealth Wisdom. I'm your host, Justin Obi. I'm here with Eric Benz and Bill Ryan of Fox Hill Wealth Management. And today we have a very special guest joining us, someone whose expertise in investment banking, mergers and acquisitions, and corporate finance makes her one of the most sought-after advisors in the middle market space. She's actually in between 6 or 7 deals right now, and it's an honor to have her with us. Rudy is the founder and president of RS Finance and Consulting. It's a boutique investment banking firm here in Boston, specializing in raising capital, M&A advisory, and strategic financial consulting for middle market companies. With over 25 years of experience, including time at Lehman Brothers and Goldman Sachs, Rudy has helped countless business owners navigate the complex financial transactions that unlock real value. Rudy, thank you so much for being here. Welcome to the show.
Thank you. Thank you for having me. I'm happy to be here.
Yeah, it's great. So just to get things started, looking at your, incredible. I don't know how I'm so impressed with your resume, but you started at Lehman Brothers and Goldman Sachs. Why not just stay there for your entire career? What made you go out on your own?
Well, those were great firms.
Yeah.
When I was in school, we were sort of coached to seek the highest challenge on the biggest stage. And so it seemed natural to go to New York. I was in college in New England, and the investment banks came on campus to recruit students. I didn't really know what investment banking was, but they said, we want overachievers, best and brightest. And I thought, okay, maybe. I ended up getting an offer from several firms. I went to Lehman Brothers, and it was fantastic. I often tell people that the best part of my career was being in New York, the 10 or 11 years that I was there, because you're really challenged by the caliber of people that you're working with and the intensity of the projects. And so I was enjoying that experience, but for family reasons, one of my parents got sick and was terminally ill. And so I came back to the Boston area where I grew up to be around during that period. And I was fortunate enough to find a regional firm here in Boston called Tucker Anthony that needed somebody with capital raising expertise, especially in the private markets. And so I was hired there and have really been, for all intents and purposes, in Boston ever since. But it's equally challenging and stimulating here. We have different challenges, and it's been a great time since I've been out of New York.
Got it. So after, what was it? Tucker
Anthony.
So is that so then after that, did you start your own firm?
There were a few stops along the way. The group that I was working in at Tucker was essentially acquired. Another firm acquired the people. And so a group of us moved, and then we moved again with another firm. And so as a group, we moved around, and along the way, there was some attrition of some of the people, but in 2008, I was still working for the guy that I had started working for at Tucker Anthony. So a group of us had stayed together, and he was probably one of the best managers I have ever worked with. Really good person and a very good cultivator of junior talent. So I enjoyed that. But I think I worked for him, trying to think, probably 10 years, and we were together.
Okay.
Yeah.
So then in 2009, you start RS Finance and Consulting.
Yes.
Was that really challenging, or because you had so much experience, it was just an easy transition?
No, it was really challenging. What happened was the great financial crisis came in September, October of 2008. most of the department, I think 33 out of 34, some big number of people in that group I was in got laid off because of this financial crisis. And so we were just like, we had no idea. We knew it was bad, but we didn't know that we were all that department was in Boston was essentially going to be shut down. So I had 7 active projects at the time, and they just ended. The market ended, market activity ended, the economy ended, everyone's jobs ended. It was pretty bad.
Wow.
And
Jeez.
we
It's
were,
like a bloodbath.
it was a bloodbath. People, even clients that I have today, that's what they talk about. They say, do you remember 2008? And so we're all scarred by that. But there was a period when none of us really knew what to do. And some people teamed up, and I didn't really know what I wanted to do. But about 9 months later, a client that I had been working with called and said, hey, is it time to get started again? And so market activity started to pick up, and I went and pitched. I had to pitch again for that same business. I had to assemble 2 of the guys who got laid off with me. We went as a team to Northern Point in Pennsylvania, I think, way up by Lake Erie. We flew when we drove, or we hiked.
Wow.
I mean, it was far. So we got there, and we had to compete with a whole bunch of firms to win this business. And we show up, we're like under this banner, RS Finance, because we didn't know what else to call it. And we won. We were like blown away. We're driving away from the northernmost part of Pennsylvania, and the phone rings, and the CEO says, hey, we're going to hire you. And we were so psyched. So anyway, it got started sort of accidentally, but it was fabulous. And when we closed that transaction, like 9 or 10 months later, I thought, all right, I can do this. I didn't know if we would succeed, but we succeeded. And that was the launch, and it never looked back. It was awesome.
Yeah, that's interesting. I was going to ask, before you started your company, did you feel like you were ready years before and you just had kind of been holding off? But it's really like that whole turn of events that happened in '08 is really kind of what propelled things, right? You know what I mean? So it was almost something out of your control, as opposed to being like, I'm going to go out on my own, start my own company, get things going. It was more survival, right? You know what I mean?
You're exactly right, Bill. That's exactly right. I thought my friends from college and roommates from college, they were like, well, I guess this is a sign. I guess you're going to have to recreate yourself. And I'm thinking, yeah, I guess so. And then this opportunity happened. I thought, we're never going to win. We don't have an infrastructure. We're sitting here on our laptops. And we won. And so it helped me understand that I had actual skills and experience that someone else found valuable, because that's how we presented. We were saying, this is how we would do it. And this is how we would, this is how we'd run your deal. This is how we would position you to buyers. This is how we would run that process. And so it occurred to me only then. I was never entrepreneurial. But this set of circumstances, it was, in a perverse way, was probably the best thing that ever happened to me, because it forced me to believe in myself and do things for myself, do things on my own, do things for my client. And it was really a personal launching pad.
Yeah, kind of getting comfortable being uncomfortable situation.
That's so cool. I feel like what you just said there is, I think, true for a lot of people maybe listening, but like a lot of times you don't understand the value you bring to the table because you take it for granted. Like, you know so much already, and
everybody knows it, right? Like you think in your head for
you
a
just
second,
assume
right?
This is normal.
Exactly.
Oh, wow. I'm stronger than I thought it was.
Exactly right. Yeah, it's exactly right. It was really quite eye-opening on so many fronts. It was a really good experience.
So that's incredible. So then you land that client, 10 months later, you finish the deal, and then it's like, what, you're building an amazing company here in Boston. I'm sure, I think as an entrepreneur, you've got to be super gritty and tough. And there's the difference between being at a big firm versus starting your own is, I think, dramatic.
Indeed. I mean, at Lehman Brothers and at Goldman Sachs, the phone rings, right? It just rings, and you answer it, and then you're hired. It's not quite that easy, but almost. And
but you've got
at
a huge
RS
brand
Finance,
backing you.
yeah, well, that's right.
Yeah.
There's a history and other people, and there's a legacy there. And The phone wasn't ringing at RS Finance initially. So you have to figure out, like, how do we do that? How does that actually happen? How do we build the Goldman Sachs brand? So we're still working on that, but it's better.
Yeah, brand building, it's a long-term game.
When you landed that
Oh,
first,
go.
you obviously had that first client.
I think we're
right?
asking the same thing. How did you end up
I was
getting
going to say,
business?
were you
word of
speaking
mouth
with other people? And
yeah.
Well, how do I do it? How did I do it subsequent to that? Or how did we do it with that one? Or
Well, like, how was it going
so-
on? Did you have while you were doing that job, like that deal, did you have other people reaching out, or were you reaching out to other people, or what, you just really mainly focusing on that one and then things led from there?
Yeah, it's a great question. So we were the three of us, because remember the two guys who had been laid off with me, we were working together but I didn't have capital to pay them. And so we were all working. We were going to share the fee at the end, and they were much younger. So they didn't have resources that they could access, capital resources to survive, basically. So they both were looking for jobs, and one by one they got hired. And so months into it, I'm like, my staff is gone. So I finished the deal.
my
I
God.
stayed solely focused on that to make sure that it got done. And you never know if they're going to get done. Sometimes they don't get done for a whole number of reasons that you can't control. But in any event, we were fortunate this deal closed, and I did end up paying the two guys because they helped me win and they helped me get ready and, start. So, but to answer your question, there was almost a 2-month lag in between deals in the first few years. So I'd close one, and then 2 months later, I'd close another. And then, I'm sorry, not 2 months, 2 years later, I would close another. And 2 years later, I would close another. And I thought, this isn't great. I need to figure out how to speed up the hire and close process. And I had older advisors, if you will, a personal network or personal advisory board, who were sort of telling me about their experience. And I just realized that you have to be out in the community, sort of networking and just meeting people and being visible in order to get business. And it's very logical in hindsight, which if you don't know to do it and you aren't proactively doing it, then people aren't thinking of you and you're not top of mind. So it just became a matter of going to see people, having a cup of coffee, having lunch, helping people with things that came up where you had expertise. And over time, it's built. You build a network or you build the reputation, and then your phone starts to ring. Still not Goldman Sachs, but it's getting better.
I think that's something we've been talking about as a firm, just how important it is to get, constantly getting in front of people, constantly networking, because there's obviously a million ways to advertise these days. And a lot of times it just comes back to getting out there, right? Just showing up, speaking with people. That's always kind of be the best way, right? To get your presence, make your presence felt, right, in the business community. So
exactly.
It's interesting that
There's a great book called Never Eat Alone by Keith Ferrazzi. And,
yes.
He talks about this, like every meal you should be networking, bringing people together all the time, because we always get together over food in our,
Yep.
Yeah.
Exactly.
Sorry. You were saying.
No.
Yeah. I just want to pivot a little bit with it says that you work in the middle market. And for our listeners, how would you describe the middle market for businesses and doing that?
Yeah, it's a great question, because in the middle market, all of us define it a little bit differently. So, for example, I'm in an industry association called the Association for Corporate Growth. And I would say ACG, as we call it, defines the middle market as sort of companies valued somewhere between 30 million and 300 million. And it's somewhere in that range. But in my market's a little bit below that, maybe 15 million to 50 million, or the lower end of it. And I call it middle market or lower middle market. Essentially, what we mean by middle market are companies that are too small to be publicly traded companies. So you're not going to buy them on the stock market. They're too small to be on the stock market, but they can still benefit from a professional, institutional caliber investor, like a private equity firm, that can bring best practices and experience and metric-driven management and capital for growth and strategic perspective. They bring skills that these smaller companies haven't developed quite as fully because they're small. So most of the companies in the middle market are privately held, or they're all privately held. Most of them are owner operated or founder operated or run by the family. Maybe it's the second or third or fourth generation, have always done it on their own. They're not necessarily professionally trained. They haven't seen the perspective that private investor has seen, where a private equity firm, for example, might own 10 different companies. So they see how this one works and how that one works and what that one's doing and that one's strategy. And so by virtue of being an investor in multiple companies, they have perspective that can be helpful to the next company that they buy and own. And they help founders and families and owner operators develop a level of sophistication that is more sort of textbook-y, if you will, but it's also born from the practical experience that these professional investors have and bring to the table. So when we're talking about middle market, we're talking about founder-owned, typically companies that stand to benefit from the presence of a professional investment group and benefit from those resources that are brought.
And are there any like particular industries that you focus on, or is it just kind of broad and you can kind of bring expertise to the table in any area?
I'm pretty opportunistic with respect to the things that I work on, and I have almost 40 years of experience. So as you do each transaction, you get exposure to a new industry typically. But I think I'm known in this market for working on more of the basic industrial types of businesses, manufacturers, distributors, business-to-business service companies, sometimes business-to-consumer service companies. And mostly it's a function of the transaction opportunities that I see. So Boston's a very collegial community, and some of the firms I technically compete with, they'll send things to me because they're either too small for them to work on or maybe a little bit more time intensive. And I'm happy to do one deal at a time. I don't need multiple deals. So I have really good colleagues, or I wouldn't say colleagues. They feel like colleagues. They're competitors who send things my way, and I'll take whatever I think I can complete. If it's something I don't think I can complete for whatever reason, I'll pass. But for the most part, I'll figure it out and get that deal done. And it could be in any industry.
Wow.
What? So, you're dealing with a lot of these founders, right? They might have either bootstrapped the company themselves or taken it over from parents or something like that. They figure it's time to sell. And I'm sure you're dealing with a lot of different personalities. But what are some of the biggest challenges that you see in the M&A business in this area?
So the owner operators and the second, third generation, the founders who bootstrap, they all have confidence in their convictions because they had to figure it out. And so in no instance has it been easy for them. And they've thought, I might not make payroll, or how am I going to get through the financial crisis? But they've had to figure it out because they haven't had other resources around typically to help them. And so when I meet them, they are confident, gritty, scrappy managers, and they've succeeded. And so it's hard then to have an outsider whom you've never met, whom you don't know, tell you, okay, we're doing this now, and you need to do these things. And they're very good about listening, and they will defer to the expert. But sometimes it gets tough because if a transaction gets really challenging, the business owner's instinct is, I've got to trust my own instincts because I've done this, I've gotten through these tough things before, and I'm going to do it. And sometimes they'll contest you and say, I don't want to do that. And you think, oh, we have to do that. Well, the deal's not going to happen. But you have a conversation and you explain what you think, and you get there. They are so inspirational to work with because they've created something great with very little help or resources to support them.
Yeah. So your job when you take on a deal is to really act as coach and advisor to see around the corners they can't see, but also to get the most value as they're selling.
Yes. I like the term seeing around corners because that's exactly right. Like the best investment bankers, in my opinion, are the oldest ones because they've banged into too many corners that they didn't see around, right? And so you just get better with each transaction. But we're tasked at the lower end of the middle market to do two things. One is you want to optimize or maximize the value of the company that you're selling, because this is that owner's last chance typically to extract value. And now the owner and his or her family have to live on this money. So you're trying to get the most value, but more often than not, the owner says, I want the right buyer, not necessarily the last dollar, but the right buyer, because I care about my employees and I want them to be safe. I want them to have jobs. I care about the community. I've been sponsoring the baseball, the Little League team here for a decade or 2 decades. I want to continue to contribute to this community, and I want the legacy of the company to carry on. And so they have more emotional attachment to their businesses, and they really want a buyer that's going to be a good steward, mostly of their people and the legacy of their company. So we're doing both of those for these sellers.
How much, just curious, because you also help with raising money, right? Is that?
Yes.
So how much right now in today's economy, like, have you been, what's the split? Is it?
I don't do a lot of capital raising anymore. I used to do that exclusively. I was hired at different firms specifically to do that. It's very hard to do in the private markets, and especially for smaller companies, for a variety of reasons, which we can talk about if you like. But raising capital is multiple times harder than selling a company. And the primary reason for that is when you sell, the buyer has complete control. And if something goes wrong, the buyer can fix it. And the buyer will take whatever measures he or she needs to do to fix whatever happened. And when you raise capital, the existing owner is the beneficiary of that capital, but typically still has more control, and the provider of the capital has less control, and it's harder when things don't go well or when there's a difference of opinion. There can be some contention. It's just a hard thing to do, but I did it for 12 years. It was very interesting work, just harder than M&A.
Got it. So right now you're really focused on M&A.
Yes. Yeah. I try to do 1 or 2 deals at a time. And so by the time I'm finishing one M&A deal, there's usually another one that I can get started with. But a couple of years ago, after COVID, when the market was a little bit softer, I did a financing. I can still do them and still do them. I'd prefer to do M&A.
Yeah, that's very cool.
Yeah, I figured that the fundraising and like those smaller firms would definitely be challenging at times, right? As someone you're looking to invest and you're saying like, all right, you've run it this way. Is there anything we can do here to kind of change these things up? I imagine that I could totally see that being a very tough situation.
Yeah, it's a great insight.
Sure, valuation's difficult too, right?
It is. Exactly right. Both of those are impediments that typically can get in the way of closing a transaction on the capital raise side.
Mm-hmm. So you said the market for mergers and acquisitions was a lot softer post-COVID. And what are you seeing this year right now? I know there's a lot of uncertainty in the stock market. I don't know what you're seeing on your end in the private sector.
Yeah, it's so interesting. The stock market's having some issues right now, but
yes, it is a tough day.
Might be a tough one today too.
Today looks similar.
So, yeah, I know.
In my end of the market, say 15 million and above of enterprise value. It's been really active since COVID. And I think what we're seeing, at least this is my interpretation of the activity, you have business owners who are maybe in their 60s or approaching 60, usually 60 or older years old. And they went through COVID, which was really stressful. And then they went through supply chain shortages, which was really stressful. And then there was inflation, which was really stressful. And then there was work from home, especially stressful for manufacturers where you can't really manufacture from home, right? And so there was a labor shortage and just a challenge of getting people, keeping them if they had to come on site. And what I'm seeing is that my clients, these business owners, they're just tired. They're like, usually you have a challenge and you get through it and you're like, okay, another 10 years of prosperity. But here it's been body blow after body blow after body blow. And people are saying,
Rudy, you just mentioned 8 stress things in a row.
yeah,
I'm sorry, I had to interrupt because they're tired.
it's been hard for them. And
Yeah.
they just, they're sort of like, enough is enough. But now I'm 64 or 65. I want to go live the rest of my life. I want to have fun. I want to travel. I want to spend time with my spouse. I want to have grandkids or spend time with them. And so you're just seeing like people are they're tired and they're looking for a change.
Yeah, next chapter. Right?
Yeah. And the professional investment community is so sophisticated now that they offer a very elegant solution to an owner that's ready for that change.
So are most of the founders you're working with, are they in their 60s or 50s?
Yeah, most of them are. I would say it seems to me that you guys may experience this yourself. When you reach a milestone birthday, you think, oh, wow, a milestone birthday. And you start to rethink, am I where I want to be in my life? Am I doing what I want? And I think 60 is an age where owners has been running his or her company for at least 2 decades, maybe 3. And it becomes kind of a seminal moment where they rethink what the rest of their life is going to look like. There's nothing magical about it other than it's a milestone, right? Because most of these people have 20, 30 good years of fight, but they think maybe I want to do something different in the next 2 decades.
Oh, sure. Yeah. I mean, absolutely. And you've got a couple, you can live out your golden years and enjoy it comfortably rather than stressfully battle the good fight.
Exactly.
Because my thought is, I mean, right now there's a lot of conversation about the baby boomers and this massive transfer of wealth that's happening. Acquisition at all levels is, especially like very small businesses that are far under your threshold. I think there's a lot of activity happening there, or it seems like, whether that's private equity wrapping up mom and pop plumbing companies or the next generation buying. It seems so that makes sense.
Yeah. Yeah. And sometimes what happens is you get an owner, you're going to meet with buyers that have expressed interest. And so you have a limited number of meetings. Maybe you do 3 or 5. Sometimes you do a few more. And the buyers are so excited about the company that they want to buy. And they're talking about all the great things that the company has. I've had owners say, maybe I should keep my company. It's a great company. Everyone likes this company. I'm doing fine here. And sometimes they second guess the decision to sell and decide that they're going to stay the course. But it doesn't happen a lot. Usually it takes a lot to get to that point. And so most of the time they close the deal.
How has it been with, we went through years and years and years of low interest rates, right? And then, now it's, the last obviously few years, it's been significantly higher. And how has that been with, what complications has that brought to the table?
Yeah. So this probably goes without saying, but I'll say it anyway for the benefit of listeners. When interest rates go up, capital becomes more expensive. For the higher end of the market, let's say north of $30 million transaction size, most of those professional investors are private equity firms, and they're using debt to fund the transaction. So a portion of the purchase price will be funded with equity from the fund, and a portion will be funded with borrowed money. So interest rates make capital more expensive, and investors are looking for a minimum rate of return on investment. So when the interest rates go up, it starts to erode that investment return. And the only way to fix that problem is to pay less for the company. So valuations typically go down. And that we saw a lot of that. A seller might have been in a process of selling and said, oh, my company's worth $80 million. And then now all of a sudden it's worth $70 million because I don't know, the math is different depending on the structure, but it's worth less now solely because of a move in interest rates. And the seller thinks, well, that's not right. I'm just going to wait till interest rates go down. But the other way that the rising rates hurt these businesses and their valuations is that your operating costs are higher. And so you are going to borrow from your bank to buy a new machine to make more widgets. And now you're not, because that interest rate is punitive, and you don't necessarily have the cash flow to support higher rates, for example. So it slows growth. It hurts valuation. In my end of the market, we were less affected by that. And I think there are two reasons for that. One is most of the companies that I sell aren't funded with a significant amount of debt because they're smaller and their balance sheets and the income statements can't really support a lot of debt. So buyers are typically not borrowing as much, and therefore interest rates have less impact. But also the sellers, for the reasons I was saying before, they're just tired, and they're sort of looking at it and saying, well, if my valuation is coming down from 20 million to 18 million, is the $2 million after tax, which is really less than 2 million, obviously, is that really going to change my life? I'm getting 18. I can deal with that. I can live with that. That's fine. That's more than enough. I'm good. And I'm just tired. But when it was 120 million and now it's 100, I don't know. There's just a psychology around loss of dollars that for no reason other than interest rates. But at the lower end, we didn't feel any effects from that.
That's incredible.
Right.
That's very interesting. Then why are deal levels so high? Oh,
Yeah,
because
it's so high.
It's kind of
Yeah.
like
So
the
you
housing
mentioned
market
older
right now.
people. Do you think it's the aging demographic has been the big reason?
I think it has. I read
Yeah.
something about that years ago. That, what did they call it? The silver tsunami, right?
Yeah.
The graying of America.
Mhm.
I mean, when you reach those milestone birthdays, you feel old, but then you realize that you're going to live another 30 years, and you think, well, maybe I don't want to sell right now. But there is this psychology of, people reaching 60 years old, they've done it. They want to do something new. They've usually accumulated enough wealth. They usually have, cute little grandkids that they want to spend time with, or they want to travel with their spot, whatever they want to do. They feel like they've put enough money away, they can live comfortably, and they want to just have a change. And we just haven't seen I haven't seen any tapering in the deal flow.
I don't blame these people. I would do the same exact thing. No,
You've seen friends pass away over the years
Yeah.
at that point, things like that, and it's probably just
You're
you
thinking
know,
about legacy.
well,
Yeah.
and that's another thing. How likely is it that your kids even want to take over your business?
Probably
Well,
not.
that's true too. Though you saw a lot more generational transfer, and we're still seeing it, but it's increasingly rare because there's so much more opportunity for people coming out of college. And while they might have thought about being in the family business, now have this exciting new AI company that wants to hire them to do cool things. And, it's exciting. So America today, every decade that goes by, our country changes dramatically because the pace of change seems faster. Technology has facilitated that. The opportunity has increased. The individual wealth per person has increased to a large extent. And I feel like people aren't as committed to the family business because there's so many other things competing for their attention and interest, and they're seeking them. But I know a couple of companies that are in Gen 4, and the owner is a world beater, right? Sees opportunity, grow, grow, grow. There's still a lot of commitment to the family business, just less than it used to be.
And I think that's impressive because I think the statistic is that by the third generation, they're so comfortable that it's hard to teach that generation discipline and work ethic and all of that, because by the third generation, you have so much wealth accumulated. And so to hear a fourth generation who is absolutely, hungry and crushing it is very cool to hear.
Yes.
When, as a business owner is selling it, they're approaching you, do you ever say, hey, you're not ready, let's come back a year? Like, what do they have to have ready to go for you to say, this makes sense and I can actually get the most value for you?
Yeah, that is an excellent question, because as somebody from the outside looking in and having done so many of these over the years, I know what the counterparty, what the buyers think. So if you have a customer that's a significant part of your business, that's a problem for a buyer. You would think that having a customer that's a significant, like a big customer that's going to take half the socks that you make is a great thing, but it's not. It presents risk. So sellers don't know these things. Here's a great example. We were working with a sock company years ago, and they worked and toiled to get their socks into a big retailer that everyone would know. And this retailer's ubiquitous in the US and elsewhere. And they were so happy when this retailer wanted to buy their socks and sell them because their sales didn't just double, they tripled and they kept growing. And it was amazing for the company. And the company went from single digit sales to double digit, 10 million, then 20 million, then 30 million. And so it was great to sell socks to this customer. But buyers were petrified and they really didn't want to, they were nervous about the customer. What happens if the customer, finds a different supplier? And while we were in the middle of that process, that customer found a different supplier and our sales went from 50 something million to like 15 million. So the sellers, you hate to learn from that experience, but so to answer your question, what we do when we meet a business owner, usually by the time I meet someone, they're ready to sell and they're convinced that they want to sell. But if I meet them and they're just thinking about it, I'll look at their business. I'll just do this assessment for them and say, okay, here are things that are great about your company that buyers are going to love. They're going to like this, 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 and this. But here are some things you probably want to think about and maybe tweak between now and a year from now because, right, customer concentration, or you're missing a key employee. You don't have anyone in the finance function, or you developed a new product, but you haven't really proven that there's a commercial market for it. So get that product, build the sales for that product. But whatever that issue happens to be, and they're not necessarily bad things. And in fact, they're usually a function of a good company that's growing. But we say buyers are going to have a problem with this and you're going to have a discount because of this. And so if you can spend 9 to 12 months trying to course correct,
fix that problem.
Yeah. And a lot of sellers don't want to do that because it took them a while to get to the point where they actually want to sell. And now they're in that mindset. And so they don't necessarily want to go back and pause and recalibrate. But if they do, they'll get more value.
Yeah. I'm sure it's hard to hear. I have to go back and do another year in the trenches and fix this problem.
Yeah. There are things to do. I met our CEO years ago, and he had a recruiting firm, still has it, and one of their customers was a very prominent brand here in the Boston area that everyone knows. That was 80% of his business, and I said, that's going to be a problem. And so over the years, he worked it down to 60, 40, 20, and now that customer is maybe around 10%. And the owner still owns it, but what he did was he found another person to come and run his business, and he put that person in place. And so the owner almost retired and spends a lot of time in Florida and elsewhere traveling. So you don't necessarily have to be the one that implements the change, but if you want the value, you need to make the change or you won't get the value.
And so did he stay on for a few years, 5 years, to help through that transition?
He continued to own the company, but he found a professional manager who would work somewhere else, and he hired that person to run the business so he could sort of be partly retired, still keeps his eye on it, but he doesn't live in the same state anymore. He lives in the South where the sun is. So, he's still at risk economically, but it's not taking up all his time like it once was.
Yeah. Right. So you think he'll sell eventually, or he hasn't?
He hasn't sold yet. I think
yet,
he will sell eventually.
So would you ever, is that how frequent in your world does the founder stay on for? Two questions, I guess. How often do they sell? Is there any seller financing in this space ever? And then secondly, do they ever stay on for like 2 years, 3 years transition?
Yeah, it's becoming, the primary reason is they are the heart and soul of the company. At the level of company, the size of company that I sell, the owner is still a very meaningful persona and a driver of that organization. So the buyer sees that and says everything revolves around this person, even though the person's building other capable professionals in the organization. It's still sort of the company's still significantly reliant on this person. So when the company gets sold, the buyer typically wants that person to stay for a year, 2 years, maybe 5 years to transition the business, depending on how involved that seller is. And the sellers are typically happy to do that because it is hard emotionally for them to separate. All their identity is wrapped up in this company that they poured decades of their time into and, their heart and soul. And so a transition out over several years is usually welcomed by them. And so it's a win-win for both sides. On the seller financing, it happens sometimes. I think the size companies that I do, that we have institutional caliber buyers, either strategic buyers or financial buyers, and they typically can,
There's really no need for that.
don't. No, the only reason they would do it is if they feel like there's a risk of losing the owner. If the owner is so significant to the business, they'll try to tie him or her economically by some sort of seller financing.
Interesting. Okay.
Yeah.
My gut was like, it probably doesn't happen at that higher level, but I know it's pretty common for small businesses.
It is.
So, and I'm sure our listeners are at all levels of business. So, yeah. Wow. I feel like we've covered so much in so little time. This has been fantastic. Right now, with rates are actually coming down slowly. I think that'll positively impact. It sounds like it'll even add more fuel to the fire.
As we sit here this morning.
Rates are coming down. So that's probably a positive, but it sounds like the economic uncertainty that's going to weigh on deal flow at some level.
Yeah.
For a lot of folks.
In the manufacturing sector, companies are sourcing raw materials, some from Canada, some from overseas, Asia, whatever. And the tariffs are causing some consternation. I think, like anything in this country, we have a speed bump and we work through it. The market will self-correct. Sellers are becoming tentative because of that and the uncertainty around it. And buyers are becoming tentative because of the uncertainty around it. But it'll correct.
Oh, it definitely will. Yeah, absolutely will correct. We're very long-term bullish on the U.S. economy and believe in the long-term potential and growth of the country. So totally agree with you there. What's a final wrap up? What's one piece of advice you would give owners right now considering selling their company?
There are so many pieces of advice, but
Sure there is. I'm sure you could write a book about that.
In fact, that's the next podcast. I would say plan early, start early, start thinking about it early, talk to advisors early, understand what might be impediments to selling. It's not something that you can decide today and start tomorrow, typically, especially with the smaller, under $100 million companies. And the earlier you start planning, the better off you'll be, from tax planning, estate planning, risk management, people management, operational. If you start thinking about it now, might be 1 or 2 years from now that you actually pull the trigger and start to sell. That's the best thing a seller can do.
That's great advice.
And we spoke with a business advisory attorney who very similar. So there's definitely a trend there.
Exactly.
Very similar advice. So
Yep.
yeah,
M&A is really hard and it's fraught with peril. You need to do a lot of planning in advance to make sure that those perilous moments don't occur. The best way to do that is to get good advisors and start early.
Absolutely. Rudy, thank you so much for being on the show today. Really appreciate your time.
Thank you guys.
All right. And so if people want to reach out to you, what's the best way to get a hold of you? Is it just to go to your website?
Yes, my website is rsfinco, FINCO.com. And there's my contact information is there and some transactions that I've done. I welcome all outreach. Love to meet anyone who reaches out. Thank you guys.
Awesome. Thanks again, Rudy.